Okay, let's dive into this. It's kind of wild when you think about it. A country with only, what, 2% of the world's population?
Yeah, barely a blip in terms of sheer numbers.
But its economy stumbles, and suddenly the whole global financial system feels it. We're talking about Japan.
Exactly. And that's what we're unpacking today.
The latest figures, well, they show the economy's taken a bit of a knock.
Definitely a step back.
They're big car companies, you know the names, they're seeing some disappointing numbers. There are definitely headwinds.
And it's not just the big industries.
No, even rice prices.
Yeah.
Still stubbornly high, apparently.
So everyday people, the consumers, they're feeling that squeeze.
Retailers, too, struggling to keep things affordable.
And this is where it gets really interesting how interconnected everything is. Japan might seem far away for some listeners.
Right, like it's just their problem.
But its financial health, well, it has these deep roots globally. It's really not just a local issue.
Because they're a massive lender, right.
One of the world's biggest. They hold, get this, over $1 trillion in U.S. government debt alone.
$1 trillion. Wow. And for decades, they've been central to global finance, partly because of this yen carry trade strategy.
Ah, yes, the carry trade.
Essentially, borrowing yen super cheap because Japanese interest rates were practically zero.
Rock bottom for years.
And then taking that money and investing it overseas in stuff that paid higher returns.
It was a huge driver.
Yeah.
A major force, like you said.
Kind of like cheap fuel for global investments.
It's a good way to put it, greasing the wheels of the whole system. But things started to shift in 2024. We saw that strategy begin to unravel.
Yeah, that's right. The yen suddenly got stronger pretty quickly, actually.
It hit Japanese stocks hard.
And it didn't stop there. We saw ripples in U.S. stocks, even in Bitcoin.
And the concerning part is, it looks like that unwinding is still happening now in 2025.
We're seeing Japanese government bonds losing value.
Long-term interest rates are creeping up.
And bond auctions actually failing, not getting enough buyers.
Yeah, that's a pretty big red flag.
So it makes you wonder, is this just Japan's story? Or is it maybe signaling something bigger?
That's the multi-trillion-dollar question, isn't it?
Yeah.
Some analysts are definitely framing it that way. Like maybe this is the beginning of the end for that whole era of easy money, super low borrowing costs.
Okay, so how did Japan get here? Into this, well, tricky spot. A lot seems to trace back to demographics, surprisingly.
Oh, absolutely. Demographics, the population's age structure, birth rates, that kind of stuff. It's fundamental to a country's long-term economic prospect.
Right, it affects everything. The size of the workforce,
Economic growth potential,
tax revenues.
and, of course, the costs of healthcare and pensions.
And Japan's situation is pretty extreme. It's literally the world's oldest country now.
About 30% over 65. That's huge.
And their birth rate, it's been below the replacement level for, like, decades. The population itself has been shrinking since 2008.
The projections are stark. They could lose something like 20 million people by 2050.
20 million. That's like the whole population of Florida just gone.
And think about the economic impact of that. A shrinking workforce usually means slower growth overall.
And at the same time, you have more retirees needing pensions, needing health care.
Which puts enormous pressure on government spending. It creates this fundamental imbalance.
Which leads us neatly to Japan's absolutely massive debt, that debt to GDP ratio.
It's staggering, over 260% and still climbing.
So fewer workers, more retirees. The government basically has to borrow like crazy just to keep the system afloat.
Yeah, the ratio just tells you how much debt they have compared to the size of their entire economy. It's a lot.
Now, for years they managed this, right? Because interest rates were near zero.
And the Bank of Japan was buying up huge amounts of government bonds, sort of artificially keeping things stable.
But this loops back to their role as a global creditor.
Exactly. That other side of the coin. For ages, they've been the world's biggest creditor nation.
Over $3 trillion in net foreign assets. That's what they own abroad, minus what foreigners own in Japan.
And like we said, the #1 holder of U.S. Treasury bonds. Still over $1 trillion worth as of this year, 2025.
And it's not just treasuries.
No, Japanese institutions own tons of other U.S. assets too. Stocks, corporate bonds, real estate. You name it.
So all this money flowing out of Japan has, for a long time, helped fund deficits elsewhere.
Kept asset prices propped up.
And generally helped keep interest rates lower globally.
Definitely a factor in keeping borrowing costs down around the world. And the key enabler, those Japanese ultra-low rates.
Which gets us back to that yen carry trade, the financial hack, as you put it.
Pretty much. Borrow yen for virtually nothing.
Convert it to dollars, euros, whatever, paid more interest.
And invest in those markets. pocket the difference.
It sounds almost too simple, but the scale was enormous.
Absolutely. That difference in interest rates, the spread, was basically free profit if the exchange rate stayed stable or moved in your favor. Multiply that by billions, hundreds of billions.
Just think about 2023. U.S. rates were over 5%.
And Japan. Still basically zero or even negative.
That's a huge gap, a massive incentive to borrow yen, buy dollars, invest in U.S. assets.
Bloomberg estimated these yen carry trades ran into the hundreds of billions, easily.
But, and this is the crucial part, it only worked as long as two things held true.
Right. You needed Japanese interest rates to stay low.
And you needed the yen to stay relatively weak.
If either of those flips, the whole trade falls apart. Borrowing gets expensive, or a stronger yen eats away your profits when you convert back.
And that started happening in 2024. The Bank of Japan, finally, after all those years,
Exactly, really.
started nudging rates up, just cautiously, but still.
And the market reaction was pretty immediate. The yen started strengthening a lot.
Over 10% against other major currencies in just a few weeks, wasn't it?
Something like that. Pretty dramatic move.
And the fallout was quick. Japanese stocks tumbled.
U.S. stocks took a hit.
Even Bitcoin dropped. Remember that?
Oh, yeah. It showed how interconnected even seemingly separate markets are. And analysts at the time were saying, look, this unwinding probably isn't finished.
And here we are in 2025. The Bank of Japan is still gradually tightening things up.
Japanese government bond yields are rising. The yen is getting stronger again.
Which puts all that global leverage built on the carry trade, trillions of dollars.
At increasing risk, it makes the whole system more fragile.
Which brings us to the Japanese government bond market itself. Some worrying signs there.
Definitely. For so long, Japan was this reliable buyer of U.S. Treasuries. But now...
Now people are talking about them maybe buying less. Or even selling.
It's a real possibility being discussed. And you see the stress in their own market. Yields on their long-term bonds have shot up.
May 2025 saw the 30-year yield go over 3%.
And the 40-year hit an all-time high, 3.6%.
Now, 3 or 3.6% might not sound earth-shattering compared to, say, U.S. rates at times.
But for Japan, historically, that's really high. It signals investors are getting nervous.
Nervous about that huge debt-to-GDP ratio we mentioned?
That's got to be a major factor. Investor confidence seems to be fraying. Remember, the Bank of Japan kept yields low for years by essentially printing money to buy the bonds.
Right, creating artificial demand.
But now they're trying to step back from that QE, that quantitative easing, so the market is testing the real value of these bonds.
And sometimes it's failing the test, like those failed auctions.
Exactly. Auctions fail when investors just aren't willing to buy the debt at the offered interest rate. To attract buyers, they have to offer a higher yield.
Which, again, makes the carry trade less attractive if Japanese bond yields are rising.
The incentive to borrow yen at zero to invest elsewhere just shrinks, right?
It's all connected. We're even seeing some weird side effects, like with that company, Metaplanet.
Yeah, the Japanese company holding a lot of Bitcoin on its books.
Their stock price surged recently. Some people think investors are seeing it as a sort of hedge.
A hedge against what? A potential bond market meltdown in Japan? It's certainly one interpretation.
It's like a vote of no confidence in the traditional system there, if government bonds look shaky.
Maybe some money looks for alternatives, like decentralized assets. We even saw a short squeeze on Metaplanet stock and Bitcoin stuff.
Explain that, the short squeeze?
So basically, lots of traders bet the price would go down. But when Japanese rates ticked up and the yen strengthened, the price went up instead. Those short sellers were forced to buy back quickly to limit their losses, pushing the price even higher.
Interesting. So this bond market trouble, it really puts Japan in a tough position, doesn't it? Their options seem limited.
Extremely limited. It's a real bind.
Okay, option 1, raise interest rates aggressively, try to fight inflation, support the yen maybe.
But with that mountain of debt,
Yeah.
even a small rate hike blows up the government's budget. We talked about that number.
A 1% increase adds, what, $85 billion in yearly interest payments?
More than their entire defense budget. So politically and fiscally, that's incredibly difficult.
Okay, option 2, keep rates low. Try to manage the debt burden.
But that risks the yen getting even weaker, which means imports cost more.
And the cost of living goes up for people already struggling. More inflation pressure.
It's a classic catch-22. Damned if you do, damned if you don't.
And the Bank of Japan already owns, like, half the entire government bond market.
Over 50%. Yet they still can't always control it, as those failed auctions show. Their power isn't absolute.
So fundamentally, Japan is facing this really deep question about whether an economy built on decades of super cheap money is actually sustainable in the long run.
Once you get hooked on zero rates,
Yeah.
getting off them is painful, potentially very painful.
And this isn't just Japan's problem in isolation, is it? It mirrors broader global trends.
Absolutely. Rising global debt pretty much everywhere,
Mhm.
creeping inflation that's proving sticky.
And it's interesting, you mentioned Bitcoin earlier. Amidst all this worry, it quietly hit a new all-time high not long ago.
Yeah, and public search interest, like on Google, wasn't even that high. It wasn't a big frenzy.
Which fuels that narrative we touched on. Maybe some parts of the financial world are starting to see the cracks in the traditional debt-based system.
With Japan being maybe the canary in the coal mine.
Possibly. The fear is if governments have too much debt, maybe they'll eventually try to, well, devalue their currency to handle it.
Inflated away, essentially.
Yeah.
Reduce the real burden of the debt by making the money worth less.
And if that's a possibility, then assets that are finite, decentralized, not controlled by a single government or central bank,
Like Bitcoin, for example.
might start looking more attractive as a potential store of value, something outside that system.
That's certainly the argument some are making. It's seen as potentially immune to that kind of central bank manipulation.
It definitely gives you a lot to think about. So just to recap, we've seen how Japan's demographics, its role as a creditor, the unwinding carry trade, the shaky bond market, it's all tangled together.
Creating a really volatile mix with potential shockwaves far beyond Japan itself.
The core issue seems to be this huge tension. Japan's internal economic problems could spill over globally because of all that debt they own elsewhere, and because these complex financial strategies are breaking down.
It's a potent combination.
So, as we wrap up this deep dive, it leaves you, the listener, with something to chew on. In a world facing record debt levels, maybe the end of the easy money era, what actually is a safe haven for your own financial future?
Is the traditional setup, the banks, the government bonds, as rock solid as
Yep.
maybe we used to think?
Definitely something worth mulling over.